Hello and welcome everyone to another market commentary from StashAway. With us again, this time remotely, our Chief Investment Officer, Freddy.
Hi there.
Hey Freddy, good to have you with us. I know we're doing the work from home as well as everyone else in Singapore at the moment. So even Freddy and I can't be in one of the recording studios in our office. So we do it like everyone else does, right? Even on CNBC and Bloomberg, you see people dialing in from their homes. So for now, that's the new normal. But that doesn't hinder us from, getting your questions answered. We'll also still be doing some events that I'll mention later. So at StashAway, everything is still working as normal. And with that being said, Freddy, before we get into any questions, wanted to chat with you and see kind of, what is your view of the market since last week? Kind of this week, markets have been positive so far. Yesterday, obviously, they started out quite high, moved to finish almost break even, right? Lower. Maybe you can put a little bit into perspective what's going on, what the news is, what you're seeing.
As you know, Monday was a very volatile day upward. It started in Asian time when we see the S&P futures that's still trading in Asian time went up by about between 8 to 9% intraday. And people were scratching their head, what's going on? We have more death tolls, more infections is still being reported. Why is the market up? Buybacks is over, right? I mean, people were attributing the solidity of the markets to buybacks. Buybacks was over. So my take is that, again, as I always maintained, the market is not linear. You can't view the market linearly. It's a fast-moving, it's a forward-looking voting engine. And it looks at, in particular, is very focused right now on the death rates. And the change in number of death cases has been going less and less. So we still have more deaths every day, but the delta, the marginal change in death has been going down. And also in terms of infections, we've seen Italy and a few other countries, the rate of change in infections are also starting to come down. That's what the market was very focused on. And that's one of the reasons that a lot of people floated for being the reason why the market opens up so much in a single day.
Thank you, Freddy. Very helpful. Anything else you're seeing? Do you think there's continued volatility over the next few weeks? Because I think, especially with the US and the UK, they seem to be lagging a little bit, right? And obviously the death rates are still spiking there. Do you see this as still some volatility ahead, or do you feel like the trajectory is more positive?
I think we are in a stalemate situation between the bulls and the bears. Obviously, the lockdown hurts the economy, lost output, but it's been replaced partially with policy stimulus. Lots of bazookas are coming in. So it's a stalemate right now. What we're seeing is a fight between the two, and the volatility I expect will remain. It doesn't matter for long-term investors like ourselves. We're investing our own savings, but I think it's particularly harmful and difficult to navigate for leveraged traders, speculators who's on margin. And so again, I think this is the best time for long-term real money investors who just focus on their own savings. It's got no impact on your plans, but it's particularly difficult for the other players.
Yeah, that makes perfect sense. Let's get into a couple of questions from listeners, because I think they coincide with some of the things you already spoke about today. One of the things that we get quite often, especially because we're using the value at risk, right? We give you a risk index level for each portfolio that we have. One of the questions we've gotten from the last video is, how much percentage of average return, right, for 1 year should I consider to be good, in relation to the VaR level? So let's say my VaR level is 20. What kind of return should I expect? Is the person asking.
To be honest, it is difficult to just put a number out there, because we optimized it, right? As you knew, given the risk level, we maximize the expected return as best we can. But that expected return is also a function of valuations at the time and the growth rates in the economy. So in good times, like last year, you can see a lowest risk portfolio gaining 14.3% on StashAway's platform. It only had a value at risk, extreme risk budget of 6.5%. So you can say that, wow, the ratio is fantastic, but that was in a good year. And in the bad year, actually, like even this year, it's actually slightly positive. Year to date so far, right, it's 0.8%. Our lowest risk portfolio, positive. But it's hard to say, in this environment, the ratio, it's not the same anymore as 2. So instead, what we focus on is to maximize it the best we can. In particular, if market valuations are very low now and somebody invested now, a recovery could even generate way more return than you expected. And then with respect to a high-risk portfolio, last year, people are gaining 31% in return, but this year you could be in the worst of the route. We're down 26%, and by now we are barely. Let me see. By now, the portfolio has regained back to 11 percentage point, right? Negative. So you are very far away from your risk budget, and that's a good news. So to pin a number, a ratio between return to the volatility or risk number is actually tough. But what I can say is this: what we are focused on the StashAway end is we look at the ratio between expected return to volatility. We also look at upside volatility versus downside volatility. So in particular, most of the portfolios we want to avoid the situation where your volatility is actually high on the downside. And in all cases, I think so far, what we have done is to at least make them on par. And most of our portfolios, they're actually above 1, meaning upside volatility tends to be higher than downside volatility. So in the financial market terms, this is called a Sortino ratio. So we do look at the Sortino ratio, which is a ratio of up days volatility versus down days. So there's a lot of ways to look at it. There's no one-size-fit-all sort of approach, right? But we just optimize it as best we can.
Yeah, I think it's a great answer, Freddy. Thank you. And if the person has any more questions, also feel free to always reach out to our client engagement team. They're happy to relay any of those questions to us as well. Thanks, Freddy. Another question, more so on the positive side of things, I think this person is looking. Ritz is asking, is there a possibility that, for example, the 36% VAR portfolio will shift to China, or some China funds or China stocks, since they appear to be on the recovery part of the graph already? Is that a possibility for StashAway to ever do this, or? Absolutely.
It's just so happened that back in mid-August last year, when we reoptimized, the US numbers are way better than anywhere else in the world. So we went into all-weather strategy for non-US, and when we invest in the growth-oriented assets, we focus them onto the US. So it may look like we are very biased for the US, but that is only because of the situation. And actually, that works out very well because, as you knew, we gained 7 to 8 percentage point in currency offsets because of the US dollar. It's the funding currencies in the world. When there's stresses in the markets, we actually get the dollar gain against Sing, against Malaysian ringgit, against a lot of other currencies. And actually, we have achieved a lot of offset in losses in this whole route. And that's why we stay within all our risk budget by a far margin, right? So that's by design. It's not an accident. So I would say the same, that conversely, when the world is growing and the US dollar may actually start declining a bit from there, we would refocus. And if China looks good, we are looking at adding China innovations funds into the mix as part of the portfolio. Also, very likely, it's just my personal opinion, with the signals we had the on the dashboard is something that we are watching out for, but it's not time yet. What ERA is watching for is a situation where we move to China innovations, or even moving out of European equities and some parts of the US and move them into Asia and Japan, where there's a 38 percentage point of market share in China. And so it's very, very possible it will be reoptimized. We just let the numbers speak for themselves.
Thanks, Freddy. I think give a good inside view of what you're thinking about in terms of portfolio construction there. So I think that person will be quite happy with that answer. Let's go to the last question for the day. We have some more which we can get to next week. But for today, the question is about stop losses and liquidating portfolios into cash, right? So the person is asking why StashAway is not using a stop loss, and why don't we liquidate customers' portfolios into cash and wait for good times to re-enter? I think you can talk a little bit about timing the market here, right, as well as the stop loss.
Well, thank you for the question. It touches on a lot of topics, but I will get to the main thing. Stop losses are generally used for margin accounts, leverage trading accounts, where because of the leverage, you do a trade, you can lever a lot, 20 times, 10 times, 50 times, who knows. A small move in the underlying can kill the whole account. And to avoid losses and margin calls, and it's generally recommended to have stop losses. That's for speculation, that's for trading. What StashAway is about is very different. We are investing your savings. And you are going to save every single month, you're going to systematically keep doing so. The stop loss concept is irrelevant in the sense that if you choose a 20% risk index with StashAway and you're down 10, you haven't hit your risk budget. It's part of your plan, your budgeted is within that. Exactly what happened this year. We are way within our budget. Then why are you reacting to the short term? Is this an investment account for the long term, or is it a trading account? Trading account is going to be very short term. Trading account has no staying power because of leverage. You have staying power because you're not borrowed, right? You investing your savings from your lifestyle, from your income, from your expenditure. You net them off, you save, you invest it. And the second point that you kind of mentioned earlier, it has to do with market timing. Market timing is very difficult to do. Not everybody can predict a crash. Even if you can predict one this time, if you wind back the clock and go back and keep doing it, when you do it enough times, I will have to conclude we are more often wrong than right. So even if you get a coronavirus right this time, you are likely wrong during the trade war. You could be wrong in 2008. There's no hard and fast rule for timing the markets. There are some people in the world that can do it, but not that. There's a very select few people who actually can do it like gods, right? So I would say that the majority of us will have to have a plan. The plan includes setting up a cash buffer so that when uncertainty happens, you draw on a cash buffer. You don't draw on your portfolio, don't sell on the low. Those are the philosophies that's designed to protect you. And two, we're advocating investing your savings. It's not leverage. And three, setting the right risk level so you don't break it. If you set a 20% risk index, you're hitting 10, 12% down in the fastest, biggest drawdown in history, you're fine. You actually have done very well. In fact, market timing, trying to get out of the market and not jumping back in correctly is often the biggest problem. Philipp, you and I know this very well. We've seen a lot of stats, and we've seen it from JP Morgan Asset Management. We've done our own studies, and it's all shown consistently over the last 25 years, any of those periods, you would easily lose a third of your return if you just miss the 10 best days in the markets. If you go through the best days and worst days, you just go through it, and if you are an S&P investor, just simplifying things, right? You just invest in S&P. Your long-term return is 9.8%. But if you just miss the top 10 best days in the 20-year period, it goes down to 6.1. If you just miss another 10 days, is it the top 20 days now, your return goes down to 3.3. And you have virtually no return at all. The cost of market timing is actually extremely high if you don't do it right. The cost of market timing is really high if you're not a trading god. So in a way, it touches on the second point where market timing is not recommended for most people who couldn't do it right. So I think the first point I mentioned is sort of like, there's no leverage, you don't need it. This is a different account. And second is more about staying true to your plans, sticking to the long term. You're long the economy, you're long the growth rate. And third, also I would say StashAway is a multi-asset portfolio, right? it's not just about the stock markets. There's gold, there's bonds, there's other commodities, there's resources. There's so many things that goes on in the investable universe. So it's actually not comparable to a single security. So I would say stop loss is oftentimes is very common. Being a professional in the past, being a hedge fund manager, being a trader before, stop losses are often hunted in the markets. What that means is that when a lot of people have a certain stop loss cluster around the same area, and in an illiquid time, and if you're getting close, you often get hunted. People try to push the market through those levels, knowing that once you hit through those levels, there will be a lot of stop losses that will result in more selling and selling and selling. It cascades. So actually professional traders and managers hunt for those stop losses. The people who mechanically does it, oftentimes you get stopped out and the market went back up and you're done, right? The so-called whipsaw happens so often. We've seen it since Trump took over the presidency. His tweet storms has created so much whipsaw. Stop losses are hunted like every single day, like no tomorrow.
Yeah, thank you, Freddy. Good answers, and like you said, yeah, we both know the missing the 10 days is painful, 20 and so on, and especially in days like this, right? One day market is down 7%, the next day it's up 10% again. If you miss that one, you know, like the delta is quite big, right? So you want to be really careful there, especially with the long-term strategy. So thank you, Freddy.
Well, if I may interrupt, I think 2 weeks back you were mentioning that we had the biggest weekly gain in history since 1932 or 33. And then on Monday, yesterday, day before, we had a 8 to 9% up move in the market. I wonder who can really time it, right, and not miss out.
Super difficult, super difficult. Yeah, exactly. Anyways, thank you so much, Freddy, for all your answers today. For everyone else, if you have any more questions for us, you can do this through our client engagement team. You know, we have WhatsApp built into the app. You can reach us on email, or via the phone still as well. For everyone else, you can also leave those questions below this video so that Freddy and I can pick them up next week. In the meantime, we do have a couple webinars coming up. We have in Singapore live webinar. It's going to be a deep dive into our asset allocation model, and this is going to be done by Freddy. That's actually on April 16th. So you'll hear it right from the CIO. And in Malaysia on April 15th, we have a webinar on investing basics. So for both of those, the links are below the video, so you can sign up for them here, as well as on our Academy page, on our website as well. Anyways, thank you again so very much for listening today. I hope you found this to be informative. Freddy and I are staying at home like everyone else, and hope that you stay home and safe as well. And we'll all get through this together, and hopefully we'll all be back in a room together at some point again. So anyways, have a wonderful rest of your week. Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.